Hello, fellow chart gazers, and welcome to another edition of the Global Markets Wrap-Up and Technical Outlook for the end of Quarter 3 of 2023. Just before we get started, I just wanted to highlight that I will be speaking at the upcoming Australian Technical Analysts Association 2023 conference in Sydney from the 20th to the 22nd of October. The conference theme is Market Conquest, Tech and Tools for Success. And if you've never been along to a conference held by the ATAA, I highly recommend it. They're a great environment to immerse yourself in all things markets and technical analysis, and you will meet some great people along the way. The networking there is second to none. I've certainly made some very good contacts there over the years, which has helped me improve as a trader along the way. The speaker list is very distinguished. Just to highlight a few: John Bollinger. I know many people tuning into this will no doubt be familiar with Mr. Bollinger and his famous bands. He'll be there to talk about those very things and also the history and application of those trading bands. So he's a giant in the industry that was well worth catching if you can. Daryl Guppy, obviously a bit of a local legend here in this country, and he will be talking about AI, which is very interesting and obviously flavor of the month at the moment. And the last one I would highlight would be Brett Steenbarger, who is someone who I consider one of the gurus of trading psychology. His books are invaluable, and I'm very excited to see him remoting in to speak with the conference from New York. And as you can see, there's a wide array of other very highly qualified speakers speaking on a really wide range of topics. So whatever your approach is in the markets, whatever your method of trading is, there will be something here that will appeal to you, and there will be a few things also that will surprise you. If you want more information, jump on to ataa.asn.au, the Australian Technical Analyst website, or just Google ATAA conference, and that will get you to all the information there. Normal disclaimers apply. Of course, the content of this presentation is general in nature and should not be considered as personal investment advice. The quote this time comes from Arthur C. Clarke, who says any sufficiently advanced technology is indistinguishable from magic. And if you've had a chance to play with some of the new AI and chat tools that are out there, you'll know that some of the results that you can get back are quite astounding. And that is one of the things that has been fueling the rally that we've seen in the stock market lately. But will it continue? Well, let's have a look. If we look at the long-term chart of the S&P 500, we can see that the uptrend is pretty much unbroken on a log scale there. You can see 2020 was the only sort of piercing of that lower trend line, but we're bang in the middle of the trend at the moment, and it doesn't look like the trend is under any threat on a long-term basis. Zooming into the weekly chart, we can see we had this very corrective pullback through most of 2022, and then early in 2023 we had this breakout rally, of course fueled by those AI exposed stocks and the big tech players who are probably going to be the ones that will profit mostly out of this AI revolution. And this has sparked this little leg up. So the question is, can we make a new high from here above that 4,800 level? We'll see as we get through this presentation whether we think that will happen or not. On the Ichimoku chart, we can see the price and the lagging line both well above the cloud at the moment, so we're in bullish territory, and that cloud support there at 3,900 to 4,100. Having a look under the hood now, and we can see that the market breadth is down at 51% of stocks above, the stocks bullish in the S&P 500. Now, we are still rallying, as we just saw on the price charts there, but we are just seeing that the peaks here are not getting any higher. You can contrast that with what happened back early in that 2021 period, where the market was making higher highs and higher lows, and the bullish percent index was doing the same thing. Now, this if you want to call this type B divergence, could morph into type A as we saw back here, but you can see it can take quite a long time for the divergence to actually precipitate into a market pullback as we saw back then. So not great for timing charts, but it's just something to be aware of, that the participation that we're seeing in this rally is only about half of the stocks are participating, and that's not good. On the NYSE, another way to look at that is look at the stocks above their 200-day moving average. Again, we're sitting about half stocks above their 200-day, half below. This obviously speaks to the narrowness of the participation. It's obviously, but the market cap means that the largest stocks are having the most influential effect on the price of the S&P 500, and those are the ones that are those big growth stocks that are being driven by the AI revolution, and that's what's carrying this market up for now. But as far as the stocks, the rest, if you like, of the S&P 500, it's only about 50-50 stocks that are willing to participate. So that is a one concern to keep at the back of your mind. Looking at the discretionary versus staples, though, this is still in a very healthy looking state. It's rising. It's often a leading indicator of the market, and so that's one thing that does bode well for the continuation of this rally for now. On the semiconductors, they have had a huge rally through that late 2022 and midway through 2023. Just starting to see it turn a little bit more sideways at the end there. Of course, while the S&P itself is still rallying. So maybe just either a pause or a pullback there that may just turn this the broader market more sideways for a time. And on the advanced decline line, well, we are rallying once again, and so that does support the case for rallying here. But if you can see, it's a little bit difficult to pick out with your eye, but the rally, the steepness, if you like, the rate of change of the advanced decline line back here through that 19, 20, 21 period, not quite as steep this side. And overall, you can see that we haven't really advanced since sort of early 2021, this area here. We've more or less sideways. And that, again, perhaps tells us that maybe the market is interested in pausing or slowing the rally at this stage. The relative performances for the year are still astounding, though. You look at the Nasdaq, first of all, up around 40% up for the year. I mean, that's just an incredible number in 1 year, and we're not even all the way through the year. We're only 8 months in. So that's a huge number, and you can see that that's really what's been pulling the rest of the broader market up. The S&P 500's up about 16%, still, about twice its average, but being pulled up mostly by the big growth stroke AI stocks that are in that Nasdaq 100 index. The Russell bringing up the year, which is the small caps, down about that 6% level. Just something to note, though. Again, you can just start to see that lower high appear there. So whether, again, this is us turning a little bit more sideways, as we'll see later on, the seasonality is giving us a little bit of headwinds at the moment too. But the rally, certainly not as strong as it was through this April and May part here. And one reason why that might be happening, of course, is that we're under the cosh, if you like, of this huge yield curve inversion that's pushing the rates, the bond yields and the cash rates up in the market. What does that mean? Well, it means it increases the cost of capital. That impacts margin lending, which is one of the fuels that fuels the stock market. It also increases the risk-free rate. So that makes bonds look much more attractive versus stocks, which can be more riskier. So you get this rotation out of the stock market and into the bond market. And as we know, those inversions can often lead to a recession. And you can see here the inversion that we're under at the moment, the 10-year versus the 3-month, is actually the steepest inversion that we've had since the very early 1980s. So that's a long time. And you can see, if you look back, the inversion that we had just prior to the global financial crisis, I beg your pardon, that's this one here, you can see that was not nearly as steep as we are in now. So, it's not, we don't have a huge amount of samples here to compare to, but you would sense that there has to be some sort of lingering effect from an inversion this steep, and the sort of hallowed soft landing that everybody keeps hoping for may be getting further and further from view. And we can see that the odds of the New York Fed are giving the odds of a recession in the next 12 months to the US economy up at 2/3. So two out of 3 chance that we will see a recession in the US in the next 12 months. On the sentiment indicators, there does seem to be a lack of call buying going on, and an increase in put buying going on, and that's sending the put call ratio up into this so-called bearish extreme. When it gets up into this bearish extreme, that tends to be bullish for the market, because you usually tend to see reversals around that period. You can see back here the sort of the COVID crash in 2020, we saw something similar. It's not getting to super extreme levels yet, so I wouldn't be too concerned. I wouldn't bank on a rally just yet from this area here. It could happen, but the higher this goes, the more chances that we will see a rally in the stock market at some point. Of course, it could just reverse from here and nothing could happen. But the further north this heads, that the more bullish that gets for the market. And on the VIX index, where you can see that we are just hanging around in this low risk area, which tends to be bullish for the market. You can see back here through 2021, we were in that low risk area. The market headed higher. And the same thing is happening now. So that's generally good for the stock market itself, that we see a low VIX. You do have to remember that the VIX is mean reverting though, so when it does get very low, it tends to spike, and that causes pullbacks in the market. So I wouldn't discount a pullback of a decent magnitude. But if it can remain in this low risk area, that is bodes well for the upside in the market. So with some of that sort of conflicting information that we're seeing there, I thought it might be a good time to bring back the segment where to from here, and just have a look at both sides of the argument and just see where we might be headed from here. So on the bullish side, of course, everybody's banking on AI being the answer. So this chart shows the implied real growth, which is basically the S&P 500 growth adjusted for both inflation and interest rates. And you can see here that we've had one of the steepest rallies in that value going back, what is that, 40, 60 years. So that bodes well, and the argument is that, well, the momentum of this growth should continue, and that will help the stock market in the short to medium term. The other thing to consider on the bullish side is that when we've had such an outstanding first 3 quarters of the year, so when the first 3 quarters are greater than 10%, that tends to help the fourth quarter. I mean, the fourth quarter is usually the best performing anyway, 3.6%. But if you add that filter to it and look at years where the first 3 quarters have added up to more than 10%, we end up with a fourth quarter that looks at least 1% better. So that's on the bullish side. On the bearish side, well, equities are starting to look expensive. So if we look at the equity risk premium, which is the earnings yield on the S&P 500 less the 10-year bond yield, you can see that it's now at one of the lowest levels since way back here in 2004. So when stocks get expensive, there's less demand for them because there's better returns elsewhere. Why not just put your money in bonds and so on? So that will tend to slow the rally down, or at least turn the market more sideways, if not down. The other thing to bear in mind is where the money comes from that filters its way into the stock market, and a lot of that is through the amount of cash that the Federal Reserve pumps into the economy. And you can see here, if we look at the Fed reserves in orange here versus the S&P 500, they're quite closely correlated. When the Fed's balance sheet is expanding, that tends to be good for the market, and when the balance sheet is contracting, the market tends to pull back. And you can see right here at the end of the chart, we're actually in a bit of a state of divergence at the moment, where the Fed's balance sheet is more or less going sideways, but we've had this huge rally in the S&P 500. So if the correlation is to hold, then either the Fed's balance sheet needs to increase or the S&P 500 needs to pull back. That's the bearish argument. And the other interesting thing I found was that if you look at the times that the S&P 500 has rallied during a yield curve inversion, every time that's happened in the last 70 years, we've ended up with a reversal, and the market has gone into either a steep correction or a bear market at some point following that. With the red line here is where we are, and that's that arrow there is where we are, and you can see that in all the other occasions it's faded either before that time or not long after that time. So that's something to keep in mind. It's not a huge number of samples. Again, it's only about 10 or so, but should that hold, then we could be looking at a correction, as long as the yield curve inversion stays inverted, which seems likely. And lastly, on the bearish side is the VIX seasonality. So we can see that the VIX tends to rally during September and October. That's probably no surprise to most people that have been in the stock market. Those months tend to be quite bearish, particularly September for the stock market. So should the VIX rally, that would obviously be bearish for the stock market, because that would imply volatility coming into the market. And if we look at the S&P 500 yearly seasonality, we can see that it's been a pretty good match so far. Here's the year to date down the bottom here. We can see that it's rallied through that sort of March to June period, turned more sideways since then. The question is, this rally that we tend to see during the last quarter of the year, will we see that this time around? If we stick to the cycle, then we should see some end of year rally. So perhaps we're looking at maybe just some short-term weakness, then an end of year rally. Whether that carries us to new highs, or whether it just continues on the sideways trajectory that we're on, will be the big question. On the presidential cycle, looking at the pre-election year, again, you can see that rally that tends to happen towards the end of the pre-election year. So that tallies in with the with what we're seeing on the yearly seasonality as well. On Calvert-Clark's pressure chart, again, this is also interesting as well, because we see that September, October, November are kind of a wash, if you like, but December this year is supposed to be, or is forecast to be, the best month of the whole year. So again, that would tend to put weight to the bullish case that we might see some end of year rally still ahead of us. On the decade cycle, it's kind of sideways, I guess you can see. Although, if you want to be really detailed, you can make an argument that there is some sort of end of year rally for year 3 that carries on into year 4. So again, if all those seasonality cycles all line up together, that could give us some Santa Claus rally towards the end of the year. And on Calvert's decade pressure chart, we can see that 3 is effectively the fourth best year, let's call it, out of the 10. So it's definitely in the upper half of returns for the decade. So again, perhaps we see some end of year rally, which makes that eventuate. Next year not looking so good, but year 5 looking one of the best of the decade. On to the Australian stock market now, and looking at the very long-term chart on the monthly chart, we can see that we are more or less sideways, I guess you would call it. We're stuck between this 7,600 all-time high and 6,850, which was the 2007 high. Basically going nowhere fast. It's just kind of wobbling around in there, and it's definitely not given us any pattern of anything much to write home about. And if you look on the weekly chart, you can see how sideways it really is. It's basically a snooze fest in here. And if you go all the way back to about June or July of 2021, that was that you could have sold the market there, and you would have been the same benefit had you held it all the way to here. So we've basically gone nowhere in 2.5 years. So that just speaks to the sideways nature of this pattern. It doesn't look like it wants to break any which way at the moment. So we'll have to wait and see. On the Ichimoku chart, it's technically still bullish just. These charts don't really work that well in sideways markets, as I've mentioned before, but bullish, yes, and cloud support at 7,071.50, which is right below the price where we are now. And if we look at the comparison to the Asian and US indexes, we can see probably the reason for why the ASX 200 is in such a sideways mode. You can see how closely correlated we are to the Shanghai Composite Index. Obviously, our economy is very closely tied with what's going on in China, which is one of our biggest trading partners, and the Chinese economy, to no one's surprise, is slowing massively at the moment. So you can see that both our stock markets are more or less about 1 or 2% up for the year. S&P 500, as we've noted before, is up 16. The Nikkei is up a massive 25% for the year, and the Hang Seng bringing up the year there down about 9%. On the currencies, the US dollar remains the monarch of the currencies, if you like, at the moment. It's just hovering around that 104 level. It's got the largest cash rate, so it attracts the most investment. It's also still the reserve currency of the world, of course, but it had this huge rally that took it all the way up to 115, and it's pulled back to that 104 level, which has been a key level of resistance and support. And it's just hovering there. It just doesn't know which way it wants to go, but it's not selling off anymore. It's not rallying, so just a little bit more sideways as it sort of gathers its breath and decides which way it wants to go next. But that strength in the US dollar, of course, is having a negative impact in all its major crosses, the Aussie dollar being a prime candidate. Did make one attempt the start of this year at that sort of 70 level, but it's fallen away since then. It's in the mid 60s once again. I wouldn't discount a revisit of that 60 level back here before it's done with that downside rally. On the euro, it just came up and touched this long-term trend line, which it remains trapped below. So kind of stuck between that 105 level and the downtrend line there. It's regained its composure since it dropped below parity there. So just kind of more or less sideways. I mean, it's a picture perfect inverse of the US dollar, given that those two currencies are so closely tied and trade large volumes of each other's currency all the time. British pound is more or less looking in a similar situation. It's also trapped under this long-term downtrend line, just hovering at that 124 level there. 120 is the key level on the downside for the pound. And on the Japanese yen, well, it continues to sink lower and lower. I mean, this is the big, massive carry trade for a lot of people, the US dollar versus the yen. And anytime there's rallies, people are just wanting to sell the yen and buy the US dollar. And so how low will it go? Well, let's have a look at the very long-term chart. This is the quarterly chart here, and you can see there is a key level way back here at this 0.0062 level that it may want to get down and touch, but certainly not looking bullish anytime soon for the Japanese yen. On the Bitcoin, we did see that rally from 15 up to over 30k, which is 100% rally, not to be taken lightly, but it has kind of dropped away from there, looking very sideways. Bitcoin's obviously a risk asset, so it's very much affected by things like the yield curve as well. So more or less sideways for Bitcoin at the moment. 19k would still be probably its key level to the downside, and 32k is the level it needs to get over to rally further. And finally, on the commodities, well, crude oil is the sort of big story of the commodities index at the moment. We've had this breakout of this descending triangle, shall we call it, where it's broken out and it's rallying. It doesn't look a lot on this time frame here, but if we compare it to what's been happening in the stock market versus the sort of the big AI stocks, the FANG stocks. NY FANG is the ETF that covers those sort of big growth stocks that have been getting boosted by AI lately. But if we just look over the last 3 months, that would just show you, number one, how sideways the stocks, those big growth stocks, have turned, and number two, how oil is now far outpacing them, up about 23% versus 6% for the FANG stocks. On the wheat and the soft commodities in general, just looking weaker, which is a good thing for food consumers. But obviously, if you're a wheat investor, that's not so good. But pulled back, we had when the outbreak of the Ukraine war started, there was a big spike over concern in supply, but that's started to fade as supply has become more available. And on the gold, well, this we still remain trapped in this little area between 2080 and 1620, and that will be getting all the Darvis box enthusiasts frothing at the mouth, no doubt, because when we do break one of these levels, it's likely to travel quite a bit. But for now, 1925 is the old high that it's skirting with. But we're triple top, at least one touch of that 1620. So it's all to play for here on the gold. On copper, very much looking sideways at the moment. Couldn't quite capture that 465 level, and it's back round about the sort of 3.7, 3.8 level at the moment, and just looking, possibly a little sort of symmetrical triangle growing in here at the moment, but nothing to write home about on copper. More or less the same story in iron ore, where we have seen this rally back to 130. It's pulled back from there, and it's just kind of dribbling its way sideways in this area between, let's call it 97 and 130. So sideways for iron ore, I guess, as the impact of the Chinese slowdown makes itself felt. So just to summarize that, the US stock market is a real question at the moment. It's looking bullish on the price charts, but we can see that some of those internals are weakening. But the seasonality towards the end of the year means that we do still have a chance of an end of year rally in the US stock market. For the Aussie 200, well, that snooze fest that we spoke about is just really sideways and going nowhere at the moment. And on the currencies, dollar is king and everything else is basically trailing in its wake. And on the commodities, we're seeing that oil turn very bullish, the soft commodities turn more weaker, and the metals are basically range bound at the moment. If you're interested in the stuff I trade, you can jump onto smartsystematictrading.com. Here's a couple of examples. This is a ASX stock rotational strategy called Sapphire, and Dolphin, my little ETF, US ETF mean revert strategy, which trades at a 90% win rate. That's been doing very nicely. It's been producing some nice trades lately, as well as we see the market bouncing around in there. So if you jump on there, you can find out more details, including full metrics and performance charts on there. Thank you very much for your attention. If you want to sign up, if you're not already on the email list for this, feel free to drop me a line, follow me on Twitter, jump on the website, and I will wish you good luck, good trading for the last quarter of the year. All the best, and bye for now.